In October 2021, a century-old bankrupt rental car company made an announcement that temporarily broke the global automotive market. Hertz declared it would purchase 100,000 Tesla vehicles. The financial media erupted. Wall Street cheered. Retail investors sent Hertz's stock surging from the ashes of Chapter 11 bankruptcy, adding billions to its market capitalization in a matter of days. Tom Brady appeared in national television commercials, plugging in a sleek Model 3 and grinning at the camera. It was pitched as a visionary pivot. The legacy dinosaur was embracing the electric future. It was the largest corporate electric vehicle purchase in history, a bold bet that signaled the internal combustion engine's days were finally numbered. It was a masterclass in corporate public relations, and it was completely, mathematically, and devastatingly wrong. Fast forward just 26 months to January 2024. The triumphant press releases are gone. In their place is a brutal Securities and Exchange Commission filing. Hertz announces it is abruptly liquidating 20,000 electric vehicles, a massive chunk of its highly publicized fleet. The company is forced to take a staggering $245 million write-down. The visionary electric dream has transformed into a $250 million financial crater. Shortly after, the chief executive officer who oversaw the rollout is gone, quietly stepping down after the spreadsheet bleeds out. How does this happen? How does a partnership with the most valuable automaker on Earth nearly destroy a legacy giant that had just survived bankruptcy? The answer lies in a fundamental misunderstanding of what a rental car company actually is. The public believes rental car companies are in the business of transportation or hospitality. They are not. They are secretly massive, highly leveraged used car dealerships. And in 2021, Hertz made the fatal mistake of letting a Silicon Valley tech company dictate the terms of their inventory. This is the story of a $245 million miscalculation. It is the story of what happens when the frictionless dreams of software disruption crash headfirst into the unforgiving reality of depreciating physical assets.
To understand why the Tesla bet failed so spectacularly, you have to look past the airport counters and the plastic loyalty cards. You have to understand the hidden mechanism that actually drives the multi-billion-dollar rental car industry. Hertz, Avis, and Enterprise do not make their real margins simply by renting you a Nissan Altima for $40 a day. The daily rental fee is just cash flow to cover overhead, insurance, and interest payments. The true business model is something called depreciation arbitrage. It is a massive, relentless, and highly calculated game of buying low, holding briefly, and selling high. Here is how the machine operates in a normal year. A rental giant approaches Ford, General Motors, or Toyota and negotiates a massive bulk purchase. Because they are buying hundreds of thousands of vehicles, they demand steep fleet discounts, often paying 15 to 20% below the sticker price. They take possession of the cars and put them into the rental pool. For 12 to 18 months, these cars are driven by businessmen, vacationers, and locals whose own cars are in the shop. Every mile driven slowly erodes the value of the vehicle, but the rental company has already plotted this decay on a rigid mathematical curve. They know exactly what a Toyota Camry will be worth after 30,000 miles. When the car hits that precise mileage marker, it is immediately pulled from the fleet and sent to auction or sold directly to consumers through the company's own used car lots. Because the company bought the car at a massive wholesale discount, the difference between their purchase price and the used car sale price is artificially compressed. In some wildly distorted markets, like the post-pandemic supply chain crisis, rental companies were actually selling used cars for nearly as much as they paid for them new. This is the holy grail of fleet management. The residual value, the price the car fetches at the end of its rental life, is the most important metric in the entire corporate hierarchy. If residual values hold steady, the company prints money. If residual values drop unexpectedly, the entire balance sheet catches fire. This model requires total predictability. It demands vehicles with cheap, abundant replacement parts. It demands a sprawling network of third-party mechanics who can fix a dented bumper or a cracked windshield for a few $100s in an afternoon. Turnaround time is absolute law. A car sitting in a repair bay is a dead asset yielding zero revenue while still incurring financing costs and depreciation. Therefore, the perfect rental car is boring, ubiquitous, and deeply understood by the secondary market. For decades, this formula worked. It survived recessions, oil shocks, and shifting consumer tastes. The math was ironclad because the automakers played alone.
Ford and Toyota needed fleet sales to keep their massive factories running at capacity. They gladly offered the discounts, knowing rental fleets served as a dumping ground for excess inventory. The relationship was symbiotic. The automaker got guaranteed volume. The rental company got the wholesale pricing necessary to make the depreciation arbitrage function. But this intricate financial dance was built on the assumption of internal combustion engines. It was built on a century of standardized supply chains, predictable maintenance schedules, and a vast ecosystem of aftermarket parts.
When Hertz decided to pivot to electric vehicles, they were not just swapping a gas tank for a battery pack. They were blindly dismantling the core economic engine that kept their company alive. They assumed the rules of depreciation arbitrage would simply transfer over to a new technological paradigm. They failed to realize that the electric vehicle market, dominated by a single mercurial billionaire, operated by entirely different laws of physics and finance. The spreadsheet was about to meet a variable it could not calculate. The financial stakes of this arbitrage cannot be overstated. A company like Hertz carries billions of dollars in vehicle debt, financed through complex asset-backed securities. The cars themselves serve as the collateral for the loans that purchase them. If the aggregate value of that fleet drops below a certain threshold, the debt covenants trigger. The company is suddenly forced to post more collateral, draining cash reserves and paralyzing operations. Depreciation is not just an accounting fiction on an income statement. It is a live wire connected directly to the company's survival. When a rental company buys a vehicle, they are essentially shorting the depreciation curve. They are betting that the open market will value that metal and rubber higher than the financing costs required to hold it. Every decision, from the choice of floor mats to the brand of tires, is engineered to protect that future resale value. Enter the electric vehicle, a completely unknown asset class with zero historical data on fleet-scale depreciation.
The characters in this drama are defined by what they desperately needed in the autumn of 2021. Hertz had just emerged from the humiliation of Chapter 11 bankruptcy. The pandemic had wiped out global travel, forcing the company to liquidate hundreds of thousands of cars just to survive. Now, under new ownership and soon to be led by former Goldman Sachs executive Stephen Shear, Hertz needed a narrative. Wall Street does not reward survival, it rewards growth. A traditional rental car company is a low-margin, capital-intensive grind. But a forward-thinking, green energy mobility platform, that commands a premium valuation. Shear and the Hertz board needed a bold stroke to signal that the old Hertz was dead and a new, tech-adjacent Hertz had arrived. On the other side of the table was Tesla, led by Elon Musk. In 2021, Tesla was scaling production at an unprecedented rate, opening new gigafactories and aiming for total dominance of the global automotive market. But Tesla had a strict, unyielding corporate policy. They do not do fleet discounts. Musk had long maintained that a Tesla is a premium product, and the price on the website is the price you pay, whether you are buying one car or 100,000. There would be no wholesale negotiations. There would be no backroom deals to guarantee residual values. Hertz wanted the PR victory so badly that they agreed to Tesla's terms. This was the first fatal departure from the ironclad laws of rental economics. Hertz agreed to pay retail prices for a massive commercial fleet. They abandoned the wholesale advantage that made depreciation arbitrage profitable. Why? Because they bought into a secondary myth generated by Silicon Valley. The belief that Teslas do not depreciate like normal cars. For years, early adopters and tech analysts had claimed that because a Tesla receives over-the-air software updates, it actually appreciates in value. It was pitched as a computer on wheels, immune to the traditional decay of internal combustion vehicles. Hertz executives looked at the historically high resale values of used Model 3s during the pandemic supply crunch and modeled those numbers forward. They assumed they could pay retail up front because they would eventually sell the cars for near retail on the back end. It was a gamble driven by pure corporate FOMO, fear of missing out. The initial announcement worked perfectly. Hertz stock soared. The financial press lauded the visionary leadership. Tesla's market capitalization briefly crossed the $1 trillion mark on the news of the Hertz order. Everybody won the news cycle. But press releases do not generate quarterly cash flow. The moment the ink dried on the purchase orders, the reality of managing 100,000 electric vehicles shifted from the marketing department to the operations managers on the ground. The executives in the boardroom had just purchased a fleet of highly advanced, heavily computerized luxury vehicles at peak retail pricing. They had tied the financial stability of a century-old company to the unpredictable
unpredictable pricing whims of a single billionaire. The trap was set. Shio's Wall Street pedigree made him a master of financial engineering, but managing physical logistics in a high-turnover environment requires a different kind of grit. The disconnect between executive strategy and ground-level reality was widening. They had built a financial model assuming perfect conditions.
But rental cars do not exist in perfect conditions. They exist in airport parking lots, harsh weather, and the hands of drivers who treat rented property with absolute disregard. The collision course was inevitable. When the first wave of Teslas hit the rental lots, the theoretical spreadsheets immediately shattered against the physical world. The friction began at the rental counter. A customer arriving at an airport after a long flight simply wants to throw their bags in the trunk and drive to a hotel. Instead, they were handed a key card to a vehicle with no traditional ignition, no standard door handles, and a massive iPad controlling every function from the windshield wipers to the glove box. Hertz employees, already stretched thin, were forced to become impromptu EV driving instructors. The checkout process, which normally takes minutes, stretched into agonizing tutorials. Then came the charging problem. Renters, unfamiliar with the geographic spacing of superchargers or the realities of battery depletion in cold weather, routinely returned the cars with empty batteries. A gas car can be refueled by a lot attendant in 3 minutes. An empty Tesla requires hours on a charger before it can be rented to the next customer. This bottleneck destroyed the rapid turnover rate that airport locations rely on to maximize daily revenue. Cars sat idle, connected to the grid, while customers waited in line. But the operational headaches were nothing compared to the catastrophic reality of collision repair. In the rental business, cars get hit. It is an actuarial certainty. When a Ford Explorer gets a dented bumper, a local body shop orders a cheap aftermarket part, pops it on, and the car is back on the road in 48 hours for a few $100s. Teslas are not built like Ford Explorers. They are engineered with massive single-piece gigacastings and complex suites of ultrasonic sensors and cameras. There is no cheap aftermarket for Tesla parts. The repair ecosystem is highly restricted and notoriously slow. When a Hertz renter inevitably backed a Model 3 into a concrete pillar, the repair process was a nightmare. The car had to be sent to a certified Tesla body shop. Parts took weeks or even months to arrive. A minor fender bender that would cost $500 on a conventional car was suddenly generating $3,000 invoices. Worse than the repair bill was the downtime. A vehicle sitting in a shop for 60 days is a ghost asset. It generates zero yield but still depreciates, still requires insurance, and still demands interest payments on the debt used to finance it. Hertz executives began to realize that the total cost of ownership for an electric fleet was astronomical. The promised savings on oil changes and brake pads were entirely wiped out by the staggering cost of specialized bodywork and extended repair delays. Yet, Hertz might have survived the operational friction if the core economic equation had held. If the cars maintained their value, the company could eventually cycle them out and absorb the repair costs. But then Elon Musk broke the math. Throughout 2022 and 2023, Tesla faced rising interest rates and growing competition in the electric vehicle sector. To maintain his aggressive growth targets and stimulate consumer demand, Musk deployed a brutal strategy. He unilaterally slashed the price of new Teslas. Again and again, the sticker price of a new Model 3 and Model Y was cut, sometimes dropping by thousands of dollars overnight. For a consumer looking to buy a new car, it was a fantastic deal. For Hertz, it was a financial apocalypse. The law of the used car market is absolute. The price of a used asset is tethered directly to the price of a new one. If Tesla cuts the price of a brand new Model 3 by 20%, the value of every used Model 3 on Earth instantly drops by at least that much. Overnight, without a single mile being added to the odometers, the residual value of Hertz's entire electric fleet evaporated. The depreciation curve they had modeled in 2021 was destroyed. They had bought the cars at the absolute peak of the market, paying premium retail prices, and now the manufacturer was aggressively devaluing the asset class. The balance sheet could not hide the carnage. The asset-backed debt structures require the collateral to maintain a specific value. As the fleet's worth plummeted, the financial strain became unbearable. Hertz found itself trapped in a depreciating asset spiral. The cars cost too much to fix, took too long to charge, and were losing thousands of dollars in resale value every time Elon Musk sent a tweet announcing another price cut.
By January 2024, the internal bleeding could no longer be contained. Hertz made the agonizing decision to pull the plug. They announced they were dumping 20,000 electric vehicles, roughly 1/3 of their global EV fleet, onto the used car market at fire sale prices. You could suddenly log on to Hertz's used car website and find thousands of high-mileage Teslas listed for $25,000, a fraction of what the company had paid just 2 years earlier. The financial toll was brutal. Hertz reported a $245 million incremental net depreciation expense. It was a staggering write-down, directly wiping out $250 million of corporate wealth. The fourth quarter earnings call was a bloodbath. Analysts who had cheered the visionary purchase in 2021 now aggressively interrogated management about the massive lapse in judgment. The stock plummeted. The massive PR win had turned into a textbook case of capital destruction. Shortly after the write-down was finalized, CEO Stephen Scherr resigned. The man brought in to shepherd the company into a high-tech future was ultimately undone by the oldest force in the automotive industry, the brutal, unforgiving gravity of vehicle depreciation. The spreadsheet had finally balanced itself, and the cost was his job. The resignation marked the end of an era that began with such immense promise. Scherr's departure was a quiet admission that the corporate strategy had fundamentally failed. The board of directors, desperate to stem the bleeding, replaced him with Gil West, a former Delta Airlines executive known for rigorous operational discipline rather than flashy financial engineering. The mandate was clear. Stop chasing Silicon Valley valuations and get back to the boring, profitable business of renting cars. The company immediately announced a pivot back to internal combustion engine vehicles, quietly purchasing tens of thousands of traditional gas-powered cars to replace the liquidated Teslas. The great electric transition was officially paused. The operational teams breathed a sigh of relief as familiar, easily repairable inventory returned on the lots. But the damage to the balance sheet was already etched in stone. A $245 million skull remained as a permanent liability.
The financial collapse of Hertz's electric vehicle fleet is not just a story about a rental car company making a bad trade. It is a defining lesson in the limits of technological disruption. For the last 2 decades, Silicon Valley has exported a dangerous financial philosophy to the rest of the economy. Software companies taught investors that growth is infinite, that marginal costs trend towards zero, and that moving fast and breaking things is the ultimate virtue. Software can be updated overnight. Code does not rust. Algorithms do not get in fender benders in airport parking garages. But when you try to apply the rules of software to the world of heavy metal, lithium-ion batteries, and depreciating physical assets, the economic reality snaps back with violent force. Hertz forgot that they live in the physical world. They forgot that their survival depends on the highly predictable decay of glass, steel, and rubber. They traded the boring, ironclad math of wholesale depreciation arbitrage for a glossy PR narrative. They treated a highly complex, heavily computerized, proprietary machine as if it were a disposable commodity. This disaster exposes the massive, unglamorous friction hidden beneath the transition to green energy. The world cannot simply flip a switch and replace a century of internal combustion infrastructure overnight. The electric vehicle revolution is not just about battery chemistry or charging speeds. It is about the deeply unsexy mechanics of the secondary market. It is about access to cheap replacement parts, the availability of trained third-party technicians, and the stability of residual values. If the used market cannot profitably absorb these vehicles, the entire economic life cycle breaks down. A new technology cannot conquer the world if it cannot survive the brutal spreadsheet of a fleet manager. Elon Musk successfully disrupted the automotive industry by acting like a software CEO, aggressively cutting prices to drive volume and crush competitors. But in doing so, he weaponized his own pricing power against his biggest institutional buyers. Tesla proved that they control the market, but they also proved they are a uniquely dangerous partner for any company relying on stable asset values. The legacy automakers, for all their faults, understood that protecting their fleet buyers protected the entire ecosystem. Today, the Hertz lots are quietly filling back up with standard gas-powered sedans. The grand vision of a fully electric rental fleet has been indefinitely delayed, sacrificed to the gods of operational efficiency and balance sheet preservation. The $245 million write-down stands as a